Welcome, Wealth Rebels, to the show, and welcome back, my beautiful friend Adam Brewer, to the show.
Hi everyone.
We don't have a lag this time. Adam, you remember last time there was a big lag between us, and I
Yeah,
think I spoke, and then it took about 10 minutes for
yeah.
you to go, yes, that makes perfect sense, right?
I know
Yeah.
it's surprising we were both in Devon as well.
Yeah, we're both in Devon, deep dark Devon. You're in Beer. You're south of the rivers, and I am north of the rivers. I think I'm always going to be a northerner, Adam, at heart, wherever I am in the world. So January 2025. This year is a huge energy year, astrologically, spiritually, financially, whatever place you're coming from, whatever you believe in, energy wise, it's a really, really big year. And I love to shift things up and make things different as your resident wealth rebel. If I didn't, I wouldn't be a wealth rebel without a cause, with a cause, whatever you want to call me. And we need to get into flow. So it's beyond timely to do things, to bring things into even more alignment. Adam, I was just explaining this to you literally just before I brought you on air, that this show, the Wealth Rebel Show, is now exclusively only on YouTube. Why? Because podcasting is becoming even more for the elite. And quite frankly, you guys want to see the guests, you want to see who you're speaking to, and you can still listen to the audio. And YouTube is by far the place that I go to find my knowledge. I was just explaining to Adam, I've got an exam tomorrow and I needed to learn about anatomy and physiology in a weekend. Where did I go to? I went to YouTube to find that knowledge. And so it is really a place that I get to share my voice, which is really, really important, as as a wealth rebel, to really share the things that I feel are authentic and to get it out there without all of the challenges of the costs of audio technician. Don't worry, I'm still going to be working with the beautiful James Eade on audio subliminals that I create and share. And they are going to be shared exclusively as well on YouTube as I focus 2025 on where I want to be, which is I want to be on Instagram. Hello, Instagram over there. And I want to be on YouTube. So do not fear. Podcast is still going out with a bang. We have some really great finale episodes, which are explosive and are going to be forever archived on Apple, Spotify, wherever else Libsyn sends my podcast to. But it means that I no longer need to pay for all of these things as well. YouTube is free. It's all free. It takes my time and energy. It takes the time and energy of beautiful guests like Adam that come on and give up their time. And that's where the magic is, where we get to create this content and give you the knowledge that we feel that needs to be heard and shared. And actually, we don't actually know what's going to come up half the time because we're very intuitive and we just let the conversation flow. So Adam's back. Adam is back. By day, you are an investment manager. By night, you're just a really, really beautiful human who has so much to give to the world with your knowledge. Your knowledge is really profound. And when I spend time with you, it lights me up, my cheeks hurt. And you give really great insight into the world of investments, and you come into the Star Portal to go even deeper in Zoom with the members. So the Star Portal, guys, is a place that I've created where you can learn how to trade all assets, not just standard investments. We talk openly in a live forum every month, and you can ask experts like Adam anything, because Adam comes in once a quarter to share his time and knowledge in that private space as well. So please come into the Star Portal. It's £8 a month. No contract. You can stay as long as you want. And with the code STAR1month at the checkout, you get a month free to come in and see what it's all about. So hit the show notes and come in and join us live and join experts like Adam to ask anything. You can ask us anything, and we will always endeavor to share our wisdom. Firstly, disclaimer alert, right? Okay, disclaimer. We talk openly about investing, but nothing we share constitutes financial advice because we don't know your personal circumstances. We share opinion, we share insights, we share our knowledge with you. but you take sovereignty of your wealth, the choices that you go on and make, do your research, and investing puts your capital at risk because they can go up as well as down. We love a little disclaimer. Okay. And so it's really, really important that you know that nothing that we're doing is giving you financial advice. We're here to share what we've picked up over our many, many, many years. Look at the wrinkles. So yeah, believe it or not, Adam and I are not as young as we look. Are we, Adam? You're younger than me, actually.
I don't feel it. I don't- Yeah, true.
Because that's the thing. One of the things I know before we dive into the content of being serious today, this is what we want to do. We want to make investing really not boring. Is that you and I have always walked into rooms with our investor colleagues and they've looked at us and gone, there's no way that those guys know anything about investing because we look too right? We look really young, and then we start talking, and it's like, okay, you have this profound level of knowledge. Maybe you do, certainly. Maybe I just bluff it and pretend like I know stuff. So let's get serious with this today. Last time we spoke, Adam, we titled the talk "Why the Rich Get Richer" with Adam Brewer, because you dropped a bomb at the end of the talk, and I would love to just little bit of a sprinkling on that bomb because we went through so many amazing highlights about investing fundamentals, why invest, the meaning behind it, compounding, easy wins. Go back and look at some of the old nuggets. But at the end, you talked about the 5%, and it just really resonated with me. What is that? Just again, just sprinkle a little bit of kind of insight into what that bomb was that you dropped at the end. It blew me away.
Well, maybe you need to remind me, but it, I think generally, and you titled it "Why the Rich Get Richer," and it's quite interesting that. And I saw something the other day in the FT showing actually about inequality, and I think this isn't quite important, and it's quite important to understand the mathematical consequence of life means that there's always going to be the top whatever percentage or something, or in wealth, in skill, talent, in anything, is going to expand away from the average. That's just it's a power law, and I think you'll find that. So if you times a number by zero, you're going to get zero. Times a number by a very, very small number but positive, each day you're going to make it's going to increase exponentially eventually. So I think really inequality, the rich get richer, things like that, is down to maths, which a
Down
lot
to
of people don't want to
mathematics.
know.
But do you know that wasn't it, Adam? It wasn't it. That was an amazing nugget, and the power of compound was really profound. But actually, what you came up with was the billionaires, the people that had created wealth, weren't rich. They came up with amazing ideas. They actually founded companies, and when you take a look at some of the self-made millionaires, actually they came up with ideas. That was the nugget at the end because that was one of the things that it can feel really disheartening if we just think that the rich get richer because they already have the wealth. 2025 is changing. There's a big energy shift, and we're dropping into a big creative energy where people are taking back the sovereignty, and we're realizing that we need to have wealth and create wealth in order to then go on and invest it so that we're not all a lost cause, basically, that actually we can go out there and create incredible businesses. And when we have ideas, don't just leave it as an idea, go out there and do something about it. There was something about that you shared.
Yeah, yeah, that's along the same lines in my opinion, because we did talk about the entrepreneurs that had all their wealth in one business, and you've got a lot of survivorship bias in there as well. You only hear about the people who have all their wealth in one business and they're in the top 20, 50 people in terms of wealth in the world, and we're always going to see that and hear those success stories. And I saw one this morning on Instagram, and I don't know who it was, but someone had a 40 years ago, they took out a loan of £125,000 to start a sandwich shop, and he turned it into 8 billion. Um, it's never as simple as that. It's never
And
as
that's it,
simple as
it's
this
not.
overnight success. And I can't remember the saying, but everyone thinks they're overnight success, but they're not. It's huge amount of work goes into the background of
Yeah.
everything they do, and we hear about those winners. But
We
it,
don't. We hear about all the negativity, I feel. Most of the time, we are hit with negative news and fear, and we're not left with any sort of like often we just feel like we can't do things and we can't go and take that loan out and take that risk. And I think one of the biggest things that I took away from always from our talks is that we have to take some risk in order to move the needle forwards. Even with investing, taking no risk is the biggest risk that we will ever take. Sitting in our comfort zone, not taking a risk, not maybe taking a chance. And then we have to do the work. We have to do the work because when we look at people like, Richard Branson, they don't just have one business, they have an eclectic mix of creations that they move along the way and they pivot and they work hard. Boy, do they work hard. And it takes that hardship, but also it takes an idea, an inspiration, and belief in yourself and in your idea that's going to take that needle forwards, I think. And
yeah,
so much of the knowledge that is out there, certainly if you just listen to the BBC, is really negative. And I think so having some inspiration that you can turn a £25,000 loan or 125 into something amazing, but it's they haven't just got there overnight. It takes commitment, compounding investment returns, compounding the little wins, either into the stock market or into your venture is really important.
yeah, and I think the other thing in that is to make sure your entrepreneurs are actually reading, or you want to start a business, you're actually reading a lot of biographies from other entrepreneurs throughout history. And I mean the last 200 years of history. And there's some really important things you can, and one actually very good one is James Dyson, um, and his iterations of how many prototypes he made for his Hoover was incredible, and the resilience he had to go through to do that. So I think that's, and it's not just him; it's huge numbers of entrepreneurs that have done the same thing, and like Estee Lauder and Henry
Yeah.
Ford and things. So
He lives down the road from me, Adam, and I know some insider knowledge because I hear these things now. I'm telling you, my run club is like the best source of knowledge. Literally, if you think you live in deep, dark Devon, right, and you don't hear things, he lives down the road, and he at the minute he's working on some sort of really fancy sauna. If anyone's going to talk to him about anything, they'll go, we need to go and talk to Em about sauna. You know, I'm a little bit obsessed with saunas, right? For your health benefits. And one of the guys, there's a really amazing guy that is at Run Club who is, he's been fundamental in like creating kombucha, and he's working with James Dyson on this next level sauna because the saunas just don't cut it for James Dyson. And I'm like, yes, you are creating in the heart of Devon. And I'm like, he's like apparently doing all these different things with his plunge pool. So people like James Dyson will invest into really innovative things, and that is really exciting. And the fact that you just mentioned James Dyson again just shows how the universe creates these synchronicities. Because literally only on Saturday was I having a chat with someone who's working with James Dyson. And what's really great about that is that he's using a local entrepreneurship. He's not using some big sauna company. He's using a carpenter that he knows is incredible, who is a person that I know at Run Club, right? And so, if you are someone that is amazing out there, you've got amazing entrepreneurs, this weave of magic will happen, and then we can start creating. But we have to really take that kind of knowledge that we have and know that we have that purpose and take it into the world and realize that there are people like James Dyson then that will do things differently, and I think that's really special.
yeah, and the other thing is to know that nothing's in a straight line. Being an entrepreneur or being an investor, nothing happens in a straight line, nothing's linear, nothing's overnight. You'll go through a huge number of failures first, and that's okay. It's just you're just trying things that didn't work, and you'll eventually, get to the right product or the right model or business model or strategy. Um, but reading about these entrepreneurs and trying to find their mistakes or things that they did that worked, I think is very, very important to know that you're not alone. You're not going for this alone. There's a huge number of people, and that's obviously why, Emma, you're here.
And that's why, as well, I think when we have these conversations, this is exactly how we should be investing. If we're going to put our money into a company, we are, and we talk about this a lot, you and I, we are buy and hold investors when it comes to long-term investing. We want to look at a company and take out that behavioral, the markets go up and down because there's volatility day to day with markets. Things are up and down, especially with the stock market. We just have to have some negative news and all company shares will fall because people will start having a flap and selling or selling short or whatever they're doing in the financial markets. When we are investing in the long game, it's like if you're starting a business, you have an idea, it's going to go through iterations, ups and downs, but you have to have a concept that you believe in. And then you take it into the world. It's exactly the same. If you want to go and start trading on the stock market and you get your stocks and shares ISA platform, maybe it's a Hargreaves, maybe it's an interactive investor, wherever it is, you can buy funds and we could talk about the difference of what a fund and a collective is. I think we did say the next talk we might dive into a little bit about what a fund, a collective, is versus a share. I think that's a really great place to start. Or you can actually go and buy a company that you believe in, like Dyson, right? Like the shares in these amazing entrepreneurs that have done the work, that continue to do the work so that you can hold that share for 10 years and then hopefully it will go up in value. Yes, it will ride out those ups and downs, is those that volatility. And then over time you might earn dividends. What are dividends? Dividends are when a company makes profit and then it decides to give a part of that profit to its shareholders in the form of a dividend. Not all companies pay high levels of dividends because they like to invest. So there's all these different things that we need to be aware of as an investor. But fundamentally, whether you get paid by capital growth or dividends and growth over time, it's the company you have to believe in, right? And do that little bit of research and find something that you care about
Yeah.
potentially.
That's right. I mean, I think there are, when we start investing, and we can talk more detail about it, but there are sort of four things you need to get your head around. Firstly is around return expectations. I think that's very important of just the general market. If we just talk about the general market a second, um, you know, get your head around what's happened historically, and that will give you a good idea of what to expect in the future in terms of what returns will be, how volatile things are. I mean, that's the second thing. Volatility expectations. Know that things are volatile. The average top to bottom fall of the market each year is about 15%, yet 3/4 of years end up positive. So it's quite important to know that. If you're the world's worst investor each year, you could lose 15% on average. Yeah, if you just stayed involved, you would make a positive return. The third thing is probably behavioral. So behavioral mistakes that you can make, behavioral prudence. It's a massive gap from satisfactory returns to unsatisfactory returns. And actually, I think there is something called the behavior gap, which is the difference between what an investment makes over a time period and what actually the average investor makes in that investment over time period. They're not the same. And you can think of, I don't hate to name sort of things, but Cathie Wood being one of them. I think she's her ARK Invest is probably the fund that's lost investors the most money, even though she's made positive returns throughout her since inception. The fourth one is your investment plan, investment strategy, and sticking to that. So you've got these sort of four things I think that are quite fundamental as a framework to start off investing and just to know and educate yourself over each of those things. Know that volatility is always going to be there. Um, know that if you've got a plan, you stick to that plan. Um, and there's a lot of behavioral stuff. And you noted the news. I mean, we talk about, bad news sells. If you're sitting down on your sofa and you're watching the TV, you are intentionally putting your emotional focus to the news and those uncontrollable global affairs. Um, and if you're trying to change your strategy because of these uncontrollable global affairs, or you're starting to become, and I keep saying emotion about it, I don't mean emotional as in you're erratic, but you're making knee. Yeah. Okay.
Welcome back, Adam. We got cut off there. You blamed your laptop. I think you just were like emotional knee-jerk reaction. I'm going to show you what an emotional knee-jerk reaction is. You were talking about the news creating uncontrollable knee-jerk reactions because we're always seeing is things that are out of our control. Let's carry on
That's
with that, 'cause I thought that was
yeah,
beautiful what you were talking about there.
that's right. I got emotional and I chucked some coffee over my laptop. That's
Can you chuck some coffee my way? I am needing that today.
exactly. Look, yeah, look, I think that's my sort of number one. I think of these 4 points, there are the behavioral parts, and we are influenced by everything we see here and how our lives has panned out so far over the years. So you've got to be really careful that doesn't sneak into a gut feeling towards your portfolio or towards your investments or how you feel about things. So, um, in the same respect as if you're ever angry and you write that email, don't send it. Give it a day and then send it, or sleep on it and then send it.
Adam, I
Or
need
don't.
to take some more of these leaves out of out of your advice. Because do you know what? What's really interesting is when it comes to my investing, I don't touch it, and I think that's because I've been doing investing literally since I left uni, left Manchester University, ripe old age of 20 22. I was on the dealing floor in London, and I think you take for granted, having 20 years now with financial markets, you become less emotional to the volatility. I used to trade volatility, Adam, right? We used to create down and inputs that, we actually missed volatility because it meant that we couldn't create as good a coupon when the vol wasn't there. So you actually start to enjoy volatility and you see that as part of normal things. And you see, actually, we're waiting for the news to come in around, non-farm payrolls and the Fed and what things are going to happen, the things that we know are coming. And then it was the unexpected things that was like, yes, we've got some volatility. Let's go and do some trading because it becomes interesting because then we see the opportunities that volatility creates because you can buy low and you can see that there's been a sell-off because you know that your strategy is this company's good, right? You know that the UK market should be good or the tech market is good. And you look at those macroeconomics and the microeconomics and you look at the company data and you can see that your investment plan long term should play out. But we get this volatility and you see the volatility. Actually, if you just stay in, you're going to be mostly positive. And actually, the companies that you're investing in on those unexpected global affairs, the companies themselves haven't technically always changed. They may face some challenges in a sector. We might see some greater headwinds. It might be a slower race, but it might be a faster race. And what you're saying here is take your emotions out of it. And I think I tend to do that where I don't, when maybe I do need to take your advice is, if someone doesn't message me back instantly, okay, don't message me back. This is my emotional side come into play in life generally. So it all affects us when we're not used to doing something and being a certain way and we're not used to investing. These four things are really, really great. um we do have unrealistic expectations. Let's dive into that. What can we expect from the stock market generally over time? I know you talk about this a lot. What can we
Yeah.
expect? We just
Um, No, I mean it does depend on what you're investing on, in who you are. There's a huge amount of stuff, but if you think about, generally it's thought of as the stock market, and let's talk about the US stock market. It's got good history. Um, has done about 10% per annum, over throughout history, and I'm talking, 50, 70, 90 years. Um, I think expectations around that over the last 100 years, I think it's only hit that average 10% probably about 8 times. So don't expect it to be that average. It'll be an average return, but don't expect it year on year to be that 10%. Expect 20%, expect 5%, expect negative 10%. Um, that's those return expectations. Also, if the long-term equity returns have been 10%, and your portfolio contains 50% equity, don't expect 10% on average for your portfolio. It's very simple stuff, and that's again maths, but
Yeah.
it's very important to go, well, if you've only got 50% equity, don't expect 10%, expect
Let's dive
5%.
deeper to
But yeah.
that because not everyone will know what you mean by equity. So, when we're talking about if you've got 10% equity and you're seeing that the stock market's going up 10% every year and your portfolio is going up 2%, equity is when you hold the shares of a company, and you might hold the shares of a company through a bond, through a fund that invests in shares in the company's in a portfolio of shares, right? But you might also have exposure to other assets like cash, like bonds. Bonds are when you lend money to a company, and lending money to a company is inherently, usually on average, less risky than being a shareholder in a company. And therefore, when you have less risk, you'd expect less return. You get fixed returns. These are different assets. So you have to know what you are invested in and therefore base your expectations on your portfolio. And I would really encourage you, if you self invest, look at your fact sheet, look at what you invested in, look at the asset allocation. If you have an investment manager like Adam, right? Or a financial advisor, ask your advisor, get them to explain it. Get them to explain to you why you have that asset allocation because it's knowledge you deserve to know. And don't be afraid to ask the questions. And that's why you can come here and learn about these terminologies so that you can be empowered to ask questions. Because often we don't ask questions. We just accept, okay, our portfolio's not doing very well, or it's not meeting my expectations. I'm feeling stressed and anxious about that. As soon as you ask the question, you'll get an answer, and maybe you'll understand it more because you've understood what an equity or a bond is, and you'll understand what Adam's talking about here. And then you become less stressed and anxious because whilst, and this is important, I just want to come on to this about the different ups and downs is in the investment returns. Whilst you're annoyed that you haven't made 10%, you might be actually happier at the compound impact of stable returns, right? Because compound impact of 5% every year can have a profound impact on your portfolio compared to 10% one year, minus 5% the next, because then you have to recover. Actually, volatility doesn't always play out really well over time, does it? We've seen that.
No, and that's, it does depend how you use the volatility, as you said before. And I remember March 2020 during COVID, was a lot of volatility. The market actually fell from the high point to the low point about 35%, which actually threw up loads of decent opportunities, to invest in these companies. You've got some very decent companies that have just fallen because everything else has fallen. So it's baby and bathwater, and so it meant that actually trading at that point was very profitable, and that was, a sort of welcomed, volatility. But you're right. If you think about again the maths involved, I've got to stop saying that. But if you drop, if you drop 25%, you've got to make up 33% to get back. If you drop 50%, you've got to make 100% back to get back to where you were. So
Yeah.
it's tougher the more you lose, and that's why I think Warren Buffett came up with the first rule in investing. Rule one of investing is don't lose money, and second rule in investing is don't forget rule number one. And
Yeah,
it's just
because someone said to me recently, Adam, I get this a lot. Oh, I should just buy a tracker fund because there's no risk in that. That's not true. I'm going to, this was actually, sorry, stepbrother. So my stepbrother said to me, he came down, I got some beautiful time over Christmas with my stepbrother, which was really nice. And he was like, there's no risk in that. If I just put money into a tracker, I was like, there is risk. It is volatile. You are tracking whichever stock market you decide to track, whatever index you pick, you put money into that index tracker fund in whatever way, it is tracking the market and the market is volatile. And if you put money in the market right now, and we talk about expectations, right? Where do we see markets going over the next 12 months? Nobody really knows ever. We never know what's going to happen ever. We never know what's going to happen in the future. We're not able to predict the future, right? We can make really good estimations. We can look at how trends are going and cycles and things like that, but we never really fully know. If you have money in a tracker fund, it could crash and then you could put 10,000 in, your 10,000 could become five. And like you say, to just get your money back, you have to make 100% back in that time, right? Do the maths. It's not risk free, but because people have talked about tracker funds making this money, and we've had markets that have just gone up and 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 up, and therefore we've seen tracker funds and passive funds performing really, really well against managed portfolios that take out the risk because it's looked like on the surface, and we only hear the positives about these low cost funds, there's been no risk. There is so much risk to your capital in that instance. It's not to say don't put money into passives. You could drip it in over time and do that alongside something that's managed or alongside something that's risk controlled. Tell me how you risk control, Adam. What do we mean by that, right? When we're trying
Well,
to
I think
manage risk.
if someone says that there's no risk in a passive, they might be correct in saying there's no stock specific risk, or there's limited stock specific risk. There's two types of risk, and we're getting a little bit in the weeds here, technical, but there's two types of risk. One is to do with that individual company that you're investing in, and one is to do with the general world and the economic environment. And so if you invest in one company, you're massively exposed to that individual company and what happens with the CEO or the revenue or their cost structure or anything like that. If you invest in two companies, you're diversifying, right? And three companies, four companies. And it's sort of said that once you get to about 20 companies, you've extinguished a lot of that stock specific risk, the individual company. So if one company falls, you've
Like
got
the
20
stat, I
companies,
like that. 20
5%.
companies. Don't
About
put all your
20.
money with
I might
Dyson.
lowball that slightly. Some people say 10, some people say 50. I think 20 is about right. And there's other reasons why I say 20, which we won't go into.
I love your
But
knowledge.
you
I just
you
love these
you
nuggets
can
of little
you
little
can
things you bring out.
you can get rid of that kind of risk, but you'll always have the global risk, that world of risk. So when you invest in a passive, say the most popular passive is the S&P 500, and that means the 500 biggest, roughly biggest stocks in the US. You are investing in 500 companies. So if something happens to one of those companies, there's I've got to be careful here, limited risk of you losing money in your investment because it's a small part. But what you do get is you get all of the systemic risk or a systematic risk, which is
Yeah,
the sort of global part.
market
So
risk.
the
Yeah.
market risk we get jumping up and down. So so you've eliminated one risk, but you can't really get rid of the market risk. Although
But that's
actually,
just the volatility, isn't it? That's the ups and downsies.
yeah,
That's when you're in it for the long game. And then one of the ways to then manage that volatility, is like, and what Warren Buffett said is you can manage those with kind of bringing in different assets, bringing in things that will counteract that. Like, for example, gold is a great hedge against equity risk, if we're going to use terminology to get people used to what we're talking about. Equity risk, stock markets, usually if we're fearing that the stock market's going to crash, people tend to run to safe havens like gold, and so having different assets in your portfolio helps you then create diversification to manage the risk so that, if the stock market fell by 50%, maybe the gold in your portfolio offsets some of that in that time
Yeah,
as well, right? And so
yeah, and I think there's loads of things you can do. The diversification can come a lot. Diversification certainly is not buying more stuff, right? That is not what diversification is. Now think about this as um, property. Everyone knows property because it's how everyone makes most of their wealth. But um, diversification is you've got enough money to buy, you know, two properties. You don't buy two properties on the same street next to each other. That is not diversification. You've got two terrace houses there, rentables, whatever. Diversification is buying one of those houses and buying a flat in the next town, um, in the center of town, and rent it out to a different cohort of tenants.
Mhm.
That's diversification, buying
Yeah,
something different. You have to buy something different, not more of the same. So that's first thing with diversification. So you said about gold. Gold is very different to stocks. That
yeah.
does work out, and it's fairly uncorrelated to a lot of things, which is quite
Love the
good.
word correlation.
Um,
What do
exactly,
you mean by
and
that? Correlation is
yeah,
that it behaves different, so it has it like one might go up when the other one goes down, so it's uncorrelated, right?
that's right. It smooths the ride. So
Yeah,
when something zigs, there's something else you've got zags. So you've got two different things. Um, yeah, you really want something that's uncorrelated, not negatively correlated particularly. Negatively correlated will smooth the falls, but you want
yeah,
something that's uncorrelated, but both
yeah,
going up at like, a good
yeah,
rate a
yeah,
year.
yeah.
And you've got a little bit be careful where you think things you think well, we're going into a lot of detail now, but when things you think they're not correlated, and actually when times are hard, they everything is correlated,
And
right?
we that's
When things
unusual,
fall,
right?
things
Like when
fall.
we in '08 that happened, everything fell,
Yeah,
right? And we've got to be real, like sometimes things do buck the trend and we can overthink these things. There's some really great nuggets here, Adam. I think we wanted to keep this to like half an hour. And these are the sorts of conversations that people can come into our world and learn more about, in the Star Portal to go deeper on these things because you stay for a whole hour at least in that world. But like, some really great nuggets here. Do your research. Look at investing like you would setting up your own business. If you want to buy stocks, maybe do your research into different companies as well. If you're going to buy 20 companies, don't buy 20 Dysons, right? You're not going to go and buy 20 Hoovers, are you? Maybe think about the things that you buy in your life. Like, why do you buy different things? Buy a pair of glasses because I need to see. I'm buying an iPhone. Think about your stock portfolio in that same way. I just bought some actual gold, not gold, sorry, actual silver coins from the Royal Mint. Okay. And I have them now, and they were my Christmas presents to my kids. You are welcome, children, right? And that is real diversification because I've got again, I'm going off on one tangent. Well, you know me, I go off on a little bit of a random thing here. You might think about your investing as going, okay, I've got my property. I've got an investment property, my flat. Yes, I might then go and buy some gold to build up some money whilst I earn enough money to buy a second property in a different town that does something different. So we can get really creative with how we build our wealth up. And if you're buying stock, we can buy, I think, we can start building up trades at £25 online to buy into the stock market on certain platforms. Start building up your 20 companies, but don't put it all into one company. Or you can go and buy a fund that is really well diversified, multi-asset, you know, different funds. But there's just some fantastic nuggets there, and taking out that emotional prudence, keeping your knowledge of volatility. Volatility is normal. Buckle in, just sit with it. Don't start trading because you've watched the news and your person down the pub has told you that the whole world is doomed. when the whole world is doomed, there's opportunities for innovation. That's what I always think. There's always something going to come up and try and sort things out. And then that's when you want to be in the market and stick to your plan. Have a plan. Have a plan, create that strategy. I love creating strategies. It's one of the things that I do bespoke with my clients is, if you have £500 a month to spare, let's give it an intention, putting some of it into your pension. We didn't talk about tax wrappers today. We can talk about some of the other things that we can do to start leveraging money around financial planning. There's so many layers to it. But oh, what a set of nuggets. Is there anything before we finish today? We have gone over half an hour. I know I lost you for a bit, but I think we've been here a little over half an hour. Is there anything that you want to finish on just to leave with the guys that are hopefully going to come in and see you within the portal, right? Even if it's for 1 month free, star 1 month.
Yeah, I think there's quite a few things that I could we could leave on. I think you've one thing we noted about the news. One thing I want to note is that we get a continuous market price of your portfolio investment. So you know every second of every day what your portfolio or investment is worth. A market price should be a tool, not a curse. Really important. Its
Yeah.
continuous availability should be utilized if the sentiment pendulum swings to your advantage, euphoria or despair, and you can buy, and euphoria you can sell. But it should not be used to formulate a short-term judgment on your assets. It's very, very important that if you don't employ um, an estate agent to value your house every second of every day, and if he's in a bad mood and he values it incredibly low, you're not going to sell. And he values it very high, you just need to use that as a tool from the market, not as a curse. I think it's very, very important that.
Yeah, don't be checking your portfolio every second of the day. Leave it alone.
Yeah,
Leave it alone and stick to your plan. Drip your money in. That's why I create the wealth strategy templates because we're giving every pound a purpose when we earn it. And we're not therefore stressing about necessarily what the market's doing, just making sure that we don't leave it in our bank account to go and spend on beers down the pub or something. No judgment, right? And that's where we usually leak money. Because we're doing something really savvy and smart then with the money we've created by taking some inspired action, even if it's going and buying another coin from the Royal Mint at 25 to £30 for an ounce of silver. We're not talking about things that we put up our nose here. Okay. We're talking about doing really smart, cool things with your money every month, whether it's putting another £25 into your stock portfolio to buy some more shares that you like in, whether it's buying a little bit more in a fund, you just get this eclectic mix of diversity that's not all in the same street, right? And I really love those nuggets. And then just leave it alone. And it's the strategy that's important. It's having that plan, it's doing something meaningful to allow the power of compound to take effect. Thank you, my love. Your wisdom always blows me away. Your energy, and we were matching with our colours today. We got the memo of what is this? What is this colour to you? I wonder if I'm always colourblind. Is it like a little, like very
not a
subtle
clue.
purple blue? Um, we obviously decided we wanted to be in sync today. Thank you, my love, so much. And I can't wait to see you in the portal next month for more conversations. And I can't wait to have you back in 3 months' time to go even deeper on this stuff for the
Absolute pleasure. Absolute pleasure.